In the early 1990s, Britain stood at a crossroads. The Cold War had ended, Europe was rebuilding its identity, and money was moving faster than ever before. London, the beating heart of European finance, was filled with optimism. Banks were expanding. Investors were confident. The pound sterling, the pride of Britain, seemed strong and stable. But beneath that calm surface, pressure was quietly building. Most people never saw it coming, a storm that would shake the foundations of an entire nation's economy and make one man a billionaire in a single day. To understand how that could happen, we have to go back to the idea of stability and control. Britain's government wanted to prove that its economy was powerful, that its currency was solid, that it could stand shoulder to shoulder with Germany and France. So, in 1990, it made a big decision to join something called the European Exchange Rate Mechanism, or ERM. The ERM was like a financial agreement between countries. Each country's currency would be locked to the value of the German mark, the strongest currency in Europe at that time. It was meant to create stability, a kind of economic unity. But there was a problem. Germany's economy was booming. Its interest rates were high. Its currency was strong. Britain's economy, on the other hand, was struggling. Inflation was high, unemployment was rising, and people were losing trust in the government's ability to manage the economy. To keep the pound locked to the German mark, Britain had to copy Germany's interest rates, even if that hurt its own people. That meant higher mortgage payments, struggling businesses, and slower growth. The British people were paying the price for a promise their government had made to Europe. And behind closed doors, economists began to whisper, "This can't last forever." On the surface, everything still looked fine. The Prime Minister appeared on TV speaking confidently about the strength of the pound. Bankers in London toasted champagne, celebrating new profits. But in the trading rooms, something didn't add up. Currency traders, people who bet on the rise and fall of money, began to notice that the pound was overvalued. It was being held up by government policy, not by real strength. And when a currency is held up by force, it only takes one push for it to fall. By the summer of 1992, tension was everywhere. The markets were restless. Every whisper, every rumor about Britain's economy sent waves across Europe. Some traders thought the government would fix it. Others thought the collapse was inevitable. And among those traders, one man was watching closer than anyone else. He wasn't British, he didn't work for a government, but he had something more powerful than both, a vision of what was coming. He studied charts, interest rates, and every policy statement coming out of London. He noticed the cracks, small at first, but growing. He saw that the British pound was standing on weak foundations. And in his mind, he started to form a plan. A plan that would challenge an entire nation. A plan that would shake the world's financial system. A plan that would soon be known as the trade of the century. But before we talk about that man and what he did, We need to understand what Britain was truly up against. Because when you bet against a currency, you're not just betting against numbers on a screen. You're betting against a government, a central bank, and the pride of a nation. And that, pause, is never a small thing. In the next chapter, we'll go deeper into the policies, the politics, and the psychology behind the coming storm. Because while most of Britain was asleep, one trader was getting ready to make history.
By the early months of 1992, the cracks in Britain's financial armor were growing wider. Investors were beginning to see what the government refused to admit. The pound was trapped. It was too strong to compete, too weak to survive, and the system that held it in place, the European exchange rate mechanism, was starting to shake. To understand how one man saw through all of this, you have to understand how money truly moves. Currencies are not just paper or numbers in a bank account. They are reflections of belief. Belief in a country, in its leaders, in its future. When that belief fades, even the strongest money can crumble. And in the spring of 1992, belief in Britain's economic strength was fading fast. Factories were closing, businesses were failing, unemployment was climbing. The British public was struggling to pay mortgages that seemed to rise every month. Yet, in Westminster, politicians continued to insist everything was under control. But markets don't listen to speeches, they listen to numbers. And the numbers, they were telling a different story. In those months, one man's attention turned sharply to the British pound, a man named George Soros. At the time, he was already famous in the world of finance, a Hungarian-born investor who had built one of the most successful hedge funds in history, the Quantum Fund. He was known not for luck, but for pattern recognition. He had a rare ability to sense when markets were lying to themselves. And he could see that Britain's currency was living a lie. He started small. He and his team began analyzing data, interest rates, inflation, capital flow. They studied how much the British government was spending to defend the pound and how much foreign currency it held in reserve. What they found was alarming. The Bank of England was bleeding money, billions of pounds, trying to keep the currency stable inside the ERM. Every time traders sold pounds, the bank would buy them back to stop the price from falling. But there was a limit to how long they could do that. Soros knew it. He understood that no central bank, no matter how powerful, could fight the market forever. Sooner or later, something would break. The key question was when. Soros believed it would happen soon. He saw how Germany's Bundesbank, the central bank that effectively controlled Europe's interest rates, was raising rates to control inflation after reunification. That meant British interest rates would also have to rise to keep up. But higher rates were already crushing the British economy. It was a trap. If Britain kept rates high, businesses would collapse. If it lowered them, the pound would fall out of the ERM. No matter what the government did, it would lose. And Soros was preparing to bet on that loss. He didn't move immediately. He watched. He waited. He listened to every statement coming from the Chancellor of the Exchequer, Norman Lamont. Every word, every press conference, every denial. It was all information. Soros believed that markets were not driven by logic, but by psychology, by fear, greed, and perception. And once enough people started to believe the pound would fall, it would. So, he began to build his position. The strategy was simple but incredibly bold. He would short the pound, borrowing it and selling it in massive quantities, with the plan to buy it back later at a much lower price. It was a bet that Britain's currency would collapse, and if he was right, the profits would be enormous. To the outside world, it looked like madness. Who would dare to challenge the Bank of England, one of the oldest and most powerful financial institutions in the world? But Soros wasn't thinking emotionally. He was thinking mathematically. He was betting on inevitability. As summer turned into autumn, the pressure built. The government kept saying the pound would hold its value. But in trading rooms across London, New York, and Frankfurt, confidence was fading. Investors began to copy Soros's move, quietly at first, then all at once. Billions of pounds were being sold each day. The Bank of England fought back, spending reserves to defend its currency. But for every pound it bought, 10 more were being sold. And still the government insisted everything was fine. Soros knew that moment, that delusion, was the final sign. He increased his position massively. Through the Quantum Fund, he borrowed more than £10 billion worth of pounds and sold them short. It was a move so large it would soon shake the entire financial world. The date was set. The markets were ready, and the trap was about to spring shut. Because when governments fight against reality, reality always wins. In the next chapter, the day of reckoning arrives, a Wednesday that would change everything. The day the pound fell, and one man made $1 billion.
September 16th, 1992. A date that would be remembered in every economics textbook, every trading floor, and every government office in Europe. It began like any other Wednesday. London was waking up. Newspapers hit the stands, full of headlines about politics and promises. But deep inside the trading rooms of the city, phones were already ringing, screens flashing, and hearts pounding. The storm had begun. George Soros and his team at the Quantum Fund had been preparing for this moment for months. Their bet was enormous. Billions of pounds borrowed and sold short. If they were wrong, they could lose everything. But if they were right, it would be one of the greatest trades in history. At exactly 7:30 in the morning, the markets opened in London, and almost instantly, the selling began. Traders across Europe and America started dumping pounds. It wasn't just Soros anymore. Hedge funds, banks, and individual investors all joined in. The pressure on the British pound became unbearable. Within hours, the Bank of England stepped in. They began buying billions of pounds, trying desperately to keep its value within the ERM. The government still believed it could fight the market. They announced that interest rates would rise from 10% to 12% in a last attempt to defend the pound. But instead of helping, it made things worse. People panicked. Businesses couldn't handle higher borrowing costs. Investors saw the move as a sign of weakness, not strength. The market smelled blood. By mid-morning, the pound was collapsing. The selling was relentless. Billions were being traded every minute. The Bank of England kept buying, but the market was simply too large. For every pound the bank defended, Soros Fund and others sold 10 more. The Chancellor of the Exchequer, Norman Lamont rushed between meetings, trying to calm the chaos, but nothing worked. The invisible hand of the market was stronger than the will of the government. At noon, the pressure reached breaking point. The bank had already spent billions, an amount that would normally move mountains. But not this time. Soros's bet was too big and too right. The British pound could no longer stay inside the ERM. The government was forced to do the unthinkable. They pulled the pound out of the system. In a single announcement, everything changed. The words echoed through the markets like a thunderclap. Britain has withdrawn from the European exchange rate mechanism. In that instant, the pound's value collapsed. Within hours, it lost nearly 15% of its worth. Billions of pounds vanished from government reserves. And on the other side of that collapse stood George Soros. His fund had made more than $1 billion in profit in a single day. The media exploded. Headlines screamed, "The man who broke the Bank of England." Politicians called it an act of financial warfare. Others called it genius. Inside trading circles, there was silence, a mix of awe and fear. Everyone realized what had just happened. A private investor had outplayed one of the most powerful central banks in the world and won. But George Soros himself didn't celebrate publicly. He understood that what had happened was bigger than just a trade. It was proof of something deeper, a lesson about how fragile economic systems really are. Because when markets lose faith in a government's promises, money moves faster than politics ever can. That was the real message of Black Wednesday. By the end of the day, Britain's leaders were humiliated. The pound was floating freely. Interest rates had to be cut again, and the government's reputation was shattered. For ordinary people, it was confusing. Prices changed, businesses struggled, mortgages became unpredictable. But for investors, one thing was clear. A new era had begun. An era where belief, not policy, controlled the value of money. As night fell over London, the chaos finally slowed. Traders went home exhausted. Screens stopped flashing red. But history had already been written. George Soros had become a legend. Not just the man who made $1 billion, but the man who proved that even nations can be wrong. And yet, even as the world called him the man who broke the Bank of England, Soros himself would later say, "I didn't break the pound. I only recognized the inevitable." The question now was, what were the consequences? What would Britain learn from this? And what would it mean for the future of Europe? Those answers.
When the markets finally closed on that September evening, a strange silence fell over London. Traders who had spent the entire day in chaos sat back in disbelief. The impossible had happened. Britain's proud currency, the pound sterling, had fallen, and with it, an illusion had shattered. The illusion that governments could always control the market. The next morning, newspapers across Europe carried the same headline, Black Wednesday. To some, it was a national tragedy. To others, a necessary correction. But to everyone, it was a shock. Billions had been lost. Confidence in Britain's economy had been crushed. The government's credibility was in ruins. In Westminster, politicians scrambled to explain what had gone wrong. The Prime Minister, John Major, called emergency meetings.
The Chancellor, Norman Lamont, faced reporters with tired eyes and trembling hands. He tried to sound confident, insisting that the decision to leave the ERM was right for Britain. But everyone knew the truth. They had been forced out. The market had pushed Britain to its knees. Behind the scenes, central bankers began to question everything they thought they knew. If the Bank of England, with all its history, power, and influence, could lose a fight like this, what chance did smaller nations have? Financial leaders across Europe started to rethink their strategies. Germany felt the shock waves. France worried about its own currency. And in the shadows, traders began whispering a new truth. The market was stronger than the state. Meanwhile, George Soros became a global symbol and a global target. The British press called him the man who broke the Bank of England. Politicians accused him of greed and manipulation. But economists? They saw something else. They saw a man who had simply recognized a flaw in the system, a system built on hope, not reality. Soros didn't create the weakness. He just revealed it. In interviews after the crisis, Soros was calm. He said, "Markets are like mirrors. They reflect human behavior." And on that day, the mirror showed fear, denial, and overconfidence. He also said something few noticed at the time. "I'm not proud of what happened. I just saw what others refused to see." That single sentence revealed something important about his mindset. To him, this wasn't about money. It was about truth. The truth hidden behind economic illusions. The impact of Black Wednesday went far beyond the trading floors. For ordinary people in Britain, the next few years were painful. Prices changed, jobs were lost, and for many, trust in the government's promises was broken forever. But there was an unexpected twist. The fall of the pound eventually made British exports cheaper, helping businesses recover and the economy grow again. It was as if destruction had cleared the way for renewal. In time, historians would look back and see Black Wednesday as a turning point, a day that changed not just Britain, but the entire way the world understood financial power. It showed that no system is unbreakable, that even the largest institutions can be wrong, and that confidence is the most valuable currency of all. Lose that, and everything else follows. While politicians searched for excuses, Soros moved on. He didn't celebrate publicly, didn't boast, didn't gloat. To him, it was simply another proof of his philosophy, that markets are driven by perception more than reality. He called it reflexivity, the idea that beliefs can shape outcomes, and outcomes can reinforce beliefs, creating a cycle that can either build or destroy entire economies. And on Black Wednesday, that cycle had destroyed the pound. But there was one more lesson, one that goes beyond money. Power isn't only about control, it's about understanding. The government tried to control what it didn't fully understand. Soros tried to understand what others were trying to control. And that made all the difference. In the next and final chapter, we'll look at the legacy of that day, how it shaped global finance, how it changed the man behind the trade, and what it still teaches us about the fragile relationship between money and belief. After Black Wednesday, the world of finance was never the same again.
Governments, banks, and investors all took a hard look at what had happened and what it meant. The event had changed everything. It wasn't just a story about money anymore. It was a story about power, psychology, and the limits of control. And at the center of it all stood George Soros. In the months that followed, Soros became a household name. To some, he was a villain, the man who brought down Britain's economy. To others, he was a genius, a visionary who had simply seen the truth first. But to Soros himself, it was something deeper. He saw it as proof of his lifelong theory that markets are not rational machines, but reflections of human emotion, fear, greed, hope, denial. These, he said, were the real forces that moved the world's money. In interviews years later, Soros spoke calmly about that day. He said, "When I see a bubble forming, I rush to buy it, because I know it's irrational, but it can still go higher." It was a strange idea that you could profit from the madness of crowds, but it was also the key to understanding how he thought. Soros didn't just react to markets, he anticipated them. He tried to understand not just numbers, but the minds behind those numbers. He treated finance as psychology, not just mathematics. The lesson of Black Wednesday was clear. Governments could no longer rely on words or policies alone. Confidence, once lost, couldn't be bought back with promises. For Britain, it was painful, but it also led to change. Freed from the restrictions of the the pound eventually stabilized on its own. The economy recovered, interest rates dropped, and exports grew. Ironically, the collapse that everyone feared became the very thing that set the stage for future growth. But globally, the message was much larger. Black Wednesday showed that the markets were now stronger than politics, that in an interconnected world, money could move faster than any government could react. And it also showed something else, that one person with the right insight and courage could stand against entire nations and win. That idea changed how people saw risk, power, and possibility. For Soros, though, the legacy was complicated. He became both admired and hated. Some called him the man who broke the Bank of England. Others saw him as a symbol of financial truth, a reminder that systems are fragile and that belief itself is the foundation of every currency. In later years, Soros turned much of his wealth toward philanthropy, supporting education, democracy, and open societies around the world, perhaps in his own way trying to balance the scales of what he had once disrupted. But the shadow of that one trade never left him. Even decades later, the name Soros still carried weight, sometimes respect, sometimes controversy, but always power. Because in the end, it wasn't just about $1 billion profit. It was about understanding something most people ignore, that the real market isn't on a screen, it's in the human mind. And once you understand the mind, you can move the world. Black Wednesday remains one of the most important lessons in financial history. It showed that even in systems built on logic and numbers, human belief is the ultimate force. Lose it, and even an empire can fall. Earn it, and you can rise above nations.
That's why decades later, people still study what happened in 1992, not just to understand the trade, but to understand the truth it revealed. Because sometimes the greatest fortunes aren't made by following the crowd, but by seeing what others refuse to see. And on that Wednesday in 1992, George Soros saw it first. The man who made $1 billion in one day and changed the way the world understands money forever.